Welcome. This is Mike Bonn with the Cash Flow Company. Today we're going to go over DSCRs and prepays. One of the things you're going to come across when you get into a DSCR is prepay penalties. And we're going to go over today, what are they, what is the actual cost to you, and what is your best option with prepays, since there are different choices. We want to go through that so you're educated, you understand, and you get into the right DSCR loan and prepay. So what are prepays? If you come across a DSCR, maybe even some other non-QM investor loans, you're going to find lenders are charging prepay penalties. It's typically a 3 to 5 year window where they'll charge some kind of exit fee. So if you pay it off early, that means if you sell it or refinance it, these loans have what they call a hard prepay. It does not matter what the circumstances are. If you pay them off in full, they're going to charge you the fee that you agreed upon. An example of a prepay penalty, let's say you have a $100,000 loan and you have a 3% penalty. That means if you pay it off during the time that you agreed that you would not pay the prepay penalty period, you would pay them 3% of the $100,000 on top of the principal and any interest and other fees owed. So you pay them an extra $3,000 when you paid off the loan. I think it's important we all understand why they charge them. It's to entice investors, large pools of money to create these products, make the DSCR available to investors, because without investors, without people putting money into them, without these large institutions, there will be no DSCR loans. But these large institutions, they don't just want to have money always turning. They have billions and trillions of dollars. They want to kind of set it and forget it. So if their money's always being paid off, kind of like a fix and flip loan or a bridge loan, it's just not ideal for certain investors. They want to attract someone or a lender or a fund that will charge less than they do on bridge loans and fix and flips. To do that, a prepay is an enticement to them to say, your money's going to be out for at least this amount. If not, you're going to get this fee to compensate for having to put that money back out into another investment. So that's why there's prepay penalties, to make sure we have these kind of programs, to make sure the money is always flowing, and to make sure the rates are where they're at. So what are the different prepay options? You'll find in DSCRs the standard prepays are either a 5-year period or a 3-year period. And what this means is for the first 3 to 5 years, depending on what you agree to, of a 30-year mortgage, there will be a penalty if you exit or pay them off prior to that period elapsing. Meaning if you have a 3-year prepay and you make it past that 3 years, then you have no more penalty. You could pay it off, you could refinance, you could sell it, whatever it is. You just have to make it past that period so you do not pay the penalty. And there's also two types, basic types. There's either a straight prepay, which means if you have a 5-year prepay, they may charge you on a straight line 5% for every year. Every year, it doesn't matter if you paid off in year 5, 4, 3, 2, or 1 of that prepay period, you're going to still pay them 5%. The same with a 3. They may have a straight 3, which means over those first 3s, does not matter when you pay them off, during those 3 years, you're going to pay them 3% of your principal balance. But they also have declining options, which means year 1, it's 5%. Year 2, it's 4%. Year 3, it's 3%, and so on until the prepay disappears. So these are the things you have to think about and look at when you're looking at DSCR or other investment kind of products to make sure they fit your timeline. Are you keeping it long term? Do you think the market's going to go down? All those things come into play when you're determining what prepay is best for you. And the good thing is if you're working with a good lender, they're going to go through all these numbers. I'm going to go through an example here real soon, but they should go through the numbers. If you're like, I'm going to be out in 2 years, or I only need it 3 years, and then I really want to exit, or I'm planning on exit, here's your options. Here's a prepay that best fits you, and here's the cost if you buy that prepay down. And yes, you could buy the prepay down, which means you could go from a 5-year prepay down to even a 2, a 1, or 0. Just remember, to get there, you're going to have to pay more on rate and more on fees. And that may make sense for a particular deal. Just depends on your cash flow and your exit strategy. DSCR are great. You just have to make sure you set them up, configure them right for this particular loan, this particular property, because you may have different needs for each property. So make sure you're setting these up correctly so you're not paying extra exit fees on properties you know you're going to get rid of. And just remember, when we're talking about prepays, when we're talking about the 5, the 5, 4, 3, 2, 1, the 3, the 3, 2, 1. These are percentages of your outstanding loan balance, not your beginning loan balance, because if you're amortizing and it's going down, it's a percentage of your loan balance when you pay it off during that penalty period. So when you're talking to a loan officer, loan broker, make sure, number one, they have options. Make sure you're working with someone who has more than one option for DSCR, because there are different DSCR companies that focus on one group, so they may not have the perfect DSCR for you. So make sure when you're talking to your lender, they have options, meaning at least 5 to 10 different DSCR buyers, funders that they could place your loan with, just to make sure you're getting the best fit. So what are the best options for you? It just depends on what you're looking for. Are you looking just to keep it 30 years and not worrying about it? Or do you think the rates will going to go down in the next 2, 3, or 5 years? Or do you just want to hold it for 2 years, make sure you get your capital gains, and exit it? Here's an example I put together on someone who has a 780 credit score and is a DSCR purchase. And I looked at what's the difference between a 5-year straight, meaning you're paying 5% per year no matter what during those 5 years, or a declining, a 5, 4, 3, 2, 1, or what if we went down from a 5-year to a 3-year, a 2-year, a 1-year, or 0? How does that impact the rate and fees when you're doing a purchase refinance? In this case, it's a purchase, but let's just look at the numbers so you can see the impact. Now, this is one particular case, and this is why you want to work with someone who's going to do and give you these numbers on your particular property to make sure it fits your goals. Now, to make this easy, we're just going to put this up on the screen so we could run through these so you could see them, maybe take some notes. So in this example, on this day, when we priced out a purchase on a $100,000 loan on a straight 5-year DSCR with a 780 credit score, interest rates on this particular product were 7.76%. Now let's look at if the only thing we change is going from 5-year down to a 5, 4, 3, 2, 1 prepay. Our interest rate only increases to 7.88, or a 12 basis points increase. So that may be worth it, especially if you think in 3 or 4 years there's going to be a drop in interest rates because your prepay is going to go down year over year. Now, what happens if you look from a 5-year to a 3-year? In this particular case, we go up to 7.985, or 225 basis points. So it is not that big of difference. We're looking at about $16 extra a month over a 1-year period, $188. So not a big difference. Even over a 5-year period, it's only $936. So once again, if you think you're going to get or want to get or have the ability to get out of this loan without paying a prepay, you may want to look at other options besides the straight 5 or even the 5, 4, 3, 2, 1. And in this case, once we get down to where we're past the standard 5 or 3 and we look at a 2-year prepay, our rate increases to just a little over 8%. So not a big increase from the original 7.76, but this is the fees start kicking in. When you start taking your prepay down below the 3%, most lenders will start charging you a higher rate and a fee. In this example, it's a 0.5 point. So you're going to pay an extra $500 on a $100,000 loan. So all of these things are going to start adding up. If you want to go down to a 1-year prepay, the interest rate's just going to go to 8.11, but you're now going to be charged a full point extra on top of the origination and everything to get down to a 1-year prepay. Once again, may be ideal for your situation. You need to make sure you're looking at this and designing it to make sure this property you're putting it in makes sense with this DSCR. Don't get trapped in a prepay penalty, but if you don't care about prepays, go for the lowest rate. In this case, we even looked at a 0%. We just went a little over 8.21%, but we also went up to a 1.5 extra on the origination, and that's what they do to help pay for those investors. So once again, you have to understand, you need to understand what prepay penalties are, because you're going to run into them not only in DSCR, but some of the other non-QM products out there. If you have a question, if you have a deal and you want someone who will actually run through all the numbers, run through all the scenarios, reach out to us. Our email is below. Also, check out our website, The Cash Flow Company. We have a lot of great tools that could save you money, save you time, that could get you farther down the line quick, and they're all free. Thanks for joining us, and we'll see you on the next video.